I am very bullish gold here. I raised my target. I don't think it was this letter, but a few letters back, a few quarters back, I raised my target to 4,000 from 3,400, and I think we're going to see that potentially by the end of this year. You're in a consolidation here. You had a great run from 2,500, I guess, to 3,500, almost 1,000 point run there. You're in a short-term consolidation here of the last few months. And I think we come out of that to the upside and have another leg up. I think silver is on its way higher. It's obviously had a run, very short term, has been kind of back and forth here. But I think you're probably next stop looking at the mid 40s. And ultimately, I have a target of 75.
Gold may not be finished with its run yet, at least not if veteran strategist DavidHunter is right. Known for calling significant turning points in markets, Hunter has been outspokenly bullish on precious metals, and his latest targets are drawing considerable attention. A few quarters back, Hunter lifted his gold forecast from $3,400 to $4,000, a level he now believes could be hit before the year ends. After climbing from around $2,500 to just under $3,500, gold has spent recent months consolidating its gains. To Hunter, that pause is essentially done, setting the stage for the next major rally. If momentum resumes, $4,000 could arrive sooner than many expect. Silver, he argues, also has room to run. While its technical picture isn't as clean as gold's, Hunter sees the metal pushing into the mid-40s before ultimately reaching $75. That timeline could stretch into next year, but the setup remains strong. A deflationary bust, which he has long warned about, would likely bring steep corrections. Silver, in particular, could see sharper pullbacks than gold. Looking further out, Hunter's ultimate targets remain eye-catching: $20,000 for gold and $500 for silver by the early 2030s. However, he cautions investors against expecting a straight-line upward trend. Those sitting on gold at $4,000 or silver at $75, waiting for the next leg higher, will probably face disappointment in the near term. In his view, the next 9 to 12 months will be marked by turbulence rather than smooth gains. For long-term believers, the real challenge will be enduring the correction without losing sight of the bigger picture. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I am very bullish gold here. I raised my target. I don't think it was this letter, but a few letters back, a few quarters back, I raised my target to 4,000 from 3,400, and I think we're going to see that potentially by the end of this year. You're in a consolidation here. You had a great run from 2,500, I guess, to 3,500, almost 1,000 point run there. You're in a short-term consolidation here of the last few months, and I think we come out of that to the upside and have another leg up. So I think, between now and the end of the year, you could see 4,000. And I think any consolidation we've had has pretty much run its course now. I think we're right at that focal point. We're going to see this thing start rallying. And the same with silver. I think silver, it's not as clear a chart, but I think silver is on its way higher. It's obviously had a run in, very short term, has been kind of back and forth here. But I think you're probably next stop looking at the mid 40s. And ultimately, I have a target of 75, and that also could happen by the end of this year. It doesn't have to. It could spill over into next year, but I think we're on our way to 75. And then in the bust, both gold and silver will get hit. Silver probably harder than gold, but they could be hit pretty hard because a deflationary bust, and that's what it, in my opinion, will be, is a deflationary bust. Gold could go, if 4,000 is the top, and obviously it could be something different than that, but if I'm right about 4,000, you might see it back to 2,500, certainly back to 3,000 or below. If silver could go, if 75 is the top, that might come all the way back to 30 or below. So, you're looking at big hits in these things, and just know, investors need to know that we're in a longer term secular bull market in the metals. My target for the early 30s is gold 20,000, silver 500. So there's a lot of upside, but there's this pocket in the bust where you're not going to probably want to buy and hold. You're not going to want to sit there at 4,000 in gold and say, yeah, but I'm waiting for 20,000, because you're going to be very disappointed for a year probably, or 9 months as it goes through a big correction. Same thing with silver. It's just I'm a contrarian, and I know sentiment better than anybody, and I know how investors work. And they can sit there at 4,000 and say, I'm a long-term holder. I'm not worried about short-term interruption. I have big upside. When you're in the midst of the bust and this thing has fallen, 30 or 40% or maybe 50%, you're going to be less sure about that upside. You're going to have a different story than you have at 4,000. And more so with silver. If silver goes from 75 to 25, for example, it's a 66% decline. You're not going to be saying, oh, yeah, but I know it's going to 500. You're going to be scared that it's going to 15. I think the Fed is in easing mode probably starting in September. And more importantly, I think the rates are going to be coming down with or without the Fed, because the economy is coming down, because inflation is not what everybody feared it would be. And I don't think that's going to change. I continue to expect, as we move through the balance of the year, the trend in inflation to be down, the trend in the economy to be down. That's positive for bonds. Scott Bessent will mix and match whatever his auctions need to be, and whoever he has working on that to make it work in terms of getting it out there. We have a huge supply of, because we've got 37 trillion in treasury debt, we've got a huge supply of constant rollovers and constant auctions. That's been going on, as you know. It's going to continue to go on. I don't think it's any more than what they've already done. And they did it during a rising rate environment over the last several months. I think as rates come down, it makes their job easier. So I just don't think the supply story, as much as that's dominated the bond desks, and the worry that that's going to push rates up, that they don't know how they're going to get all the, I don't think that's the story. I think the story really is a surprise in how much rates are going to drop from here. So with the 10-year at 430, I believe, like I said, over the course of the balance of this year, which is, basically 4 more months, I think you could see it down to 3%. If you have a 3% 10-year, that's telling you that those auctions are not causing problems.
DavidHunter isn't backing away from his call for a parabolic blow-off in equities, but he does caution that bumps along the way are likely. He sees the S&P 500 dipping to 6,100 or even 6,000 in the short term, with the Nasdaq potentially retracing 8 to 10% from recent highs. To him, though, these would be nothing more than pauses before a much larger surge. His latest roadmap is bold, the S&P climbing to around 8,700, the Nasdaq touching 30,000, the Dow surging towards 60,000, and the Russell 2000 advancing into the 3,300 to 3,400 range. That would mean gains ranging from 35% to well over 50% from current levels. What makes this possible, he argues, is the apparent shift already underway in interest rates. Even though the Fed hasn't yet moved, markets expect a quarter-point cut in September. More importantly, the bond market itself is leading the way, with the 10-year yield already trending lower. In Hunter's view, the Fed isn't steering policy anymore. It's reacting to what the bond market dictates. Inflation data adds another layer to his case. While headline CPI remains around 2.5% to 3%, alternative gauges like Truflation suggest price growth has already slipped below 2%. He believes that official housing and rental figures are overstated, making inflation appear stickier than it actually is. Combine that with a slowing economy that may already be in recession, and the conclusion is straightforward. Rates are headed down. That, Hunter says, is the fuel for the final explosive leg higher in this cycle. Let's get back to the interview.
The market is as I've been saying for a long time, we're in a melt up, heading for a 43-year top. Last time I was on with you, the market was down 20%, and everybody was getting bearish back in April. I talked about the tariffs back then and said people are overreacting. There's a lot of it is negotiation, and you got to let the dust settle, let this play out. And that I actually raised targets back then. So when everybody else was lowering targets and getting bearish, I was getting more bullish, and it's played out. Obviously, we're at new highs. And so I think the real story out there is that we're still in this final leg of a 43-year secular bull market. and that there's a lot of upside here between now and the end of the year. So I think we're in a historic rally. I think it's going to go parabolic. We're in a correction right now, and I would not be surprised if we see, the S&P back to 6,100, maybe even back to 6,000. I wouldn't be surprised to see the NASDAQ down 8 to 10% from its recent high. So, we're looking at a historic market, but it's not ever straight up. There's going to be a period of consolidation always. So that's a worst case for me. NASDAQ 10%, S&P 8%, and it's probably going to be. It could very well be less than that. Could be half that. So you just have to kind of let this little sell off, this little correction play out, and then I think. After that, we could see the parabolic where it goes almost vertical and covers an awful lot of ground in a hurry. My targets, and I raised them in my most recent letter. So my targets are S&P 8,700, NASDAQ 30,000, the Dow 60,000, and the Russell 2000 I have raised up from 3,300 to 3,400. If you do the calculus on those, I'm talking 35 to better than 50% from here. The Fed hasn't cut yet. The Fed is cutting, most likely going to cut in September, probably a quarter, but who knows? And I think between now and then, the 10-year is coming down. I think rate declines are imminent. I think you had a backup in rates that is all over. So I am not in that camp that thinks rates are going up. I am in the camp that thinks rates are imminently close to rolling over. And that's exactly right. I've made the case, in fact, that it doesn't matter what the Fed does in September, rates are coming down anyway because the bond market sets rates, not the Fed. So if the Fed cuts, it only helps the case. But I'm not in the camp that watches the Fed and says, "Oh, what are they going to, their implication for the bond market?" I think we're in a situation where inflation is pretty much contained, under 3%, 2.5%, 3%. And if you look at places, models like Trueflation, the model, they're actually below 2. But because the CPI and the other measures that the government follows do not really account for the slowing in housing that we've seen. So, in housing or rental inflation. So I think ultimately inflation is coming down and is pretty much contained here, and the economy is slowing and may already be in recession. So to me, rates are about to roll over, and they're, yes, the street pays attention to the Fed a lot more than I do in terms of determining rates. So they may be waiting on, Powell's speech this Friday. They may be waiting on the Fed meeting in September. But ultimately, I think the market's going to lead the Fed. I believe the 30-year will, lag that by some, but it's coming down as well. And short rates will be even lower. Part of that is the Fed easing, but part of it is just the market recognizing the economy is slowing and inflation is not the risk. Jobs are becoming harder to get, et cetera. We're going to start seeing that, I think, this fall. So the Fed is behind the curve. The Fed will have to catch up over the course of the next 6 or 9 months. Ultimately, in the bust, which is really next year's story, I think you could see a 0% 10-year and a 0.5% 30-year, if not lower, and short rates in the negative territory. The reason for that is a very weak economy, as I said, global bust. And a Fed, along with every central bank out there, but a Fed, in our case, buying up every treasury in sight. That's how you create QE. So there'll be, those people out there, and it's a consensus, who believe that there's going to be an excess supply of bonds and not enough buyers, particularly foreign buyers, but other than the Fed, are underestimating how much the Fed's not going to be able to find all the bonds they need.
What stands out in Hunter's outlook is the sheer scale of what he envisions. His projections suggest a market landscape where both stocks and metals could post record-breaking moves within a relatively compressed time frame, fueled by falling yields and shifting investor psychology. At the same time, he warns that volatility will be a constant companion, with sharp retracements likely to test conviction before the next leg higher unfolds. For gold and silver, that means not just watching prices climb, but also bracing for painful reversals that may shake out weaker hands. For equities, it means respecting the possibility of short-term pullbacks, while recognizing that the broader arc could remain firmly upward. In this framing, patience and discipline may matter as much as the assets themselves. Could the coming year prove to be the rare stretch where both equities and precious metals defy their usual patterns and rally together, reshaping traditional ideas of diversification? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.